Namaskaram, aspirants, and welcome to this special explainer from Rungta IAS Academy. Today, we've got an absolutely critical RBI data update, and we've curated it specifically for your General Studies Paper 3 Economy syllabus.
Exactly.
We're doing a high-speed, strictly syllabus-focused analysis of that massive $11.7 billion foreign investment outflow you've been reading about. Let's dive right in and decode what this actually means for the Indian economy. So, here's our structural roadmap. We're going to quickly cover the capital outflow itself, contrast the resilience of FDI against the flight of FPI, look at the macroeconomic impacts on the rupee and reserves, zoom out to the annual trend, and finally, tie it all back to your GS3 and interview prep. Let's kick things off with Section 1, that staggering $11.7 billion capital outflow. Negative $11.7 billion. Now, mark this in your notes, aspirants. This massive net outflow of foreign investment hit in the very first month following the outbreak of the West Asia crisis.
Right, it's literally a textbook example for your exams. It clearly demonstrates how geopolitical instability instantly translates into massive economic shocks for emerging markets like ours.
And as pointed out by economist TCA Sharad Raghavan, as future administrators, you really need to be able to spot the silver linings, the positive trends, even amidst overall negative shocks.
Absolutely. The official RBI data shows that net foreign direct investment, or FDI, actually stayed positive in March 2026. Money was still flowing into the country even while overall gross inflows slowed and total investments took a deep dive into the negative.
Which brings us right to Section 2, understanding this FDI resilience versus the FPI flight. Here is the crucial divide you need to understand for your mains. On one hand, we had a $1.6 billion positive inflow in structural net FDI. This is the good stuff, long-term money flowing directly into growth-generating assets. But, and it's a big but, that positive inflow was completely overshadowed by a massive $13.3 billion exodus of net FPI, or foreign portfolio investment. That is volatile hot money. It rapidly flees short to medium-term stock holdings the second there's global panic. So, you might be wondering, why did FDI manage to stay positive amidst all this market chaos?
Well, it comes down to a concept called repatriation. As the RBI bulletin highlights, repatriation is simply the return of foreign earnings or investment capital back to the home country. In March 2026, this stood at a relatively low $2.3 billion. That's a 40% drop year-on-year. Basically, because foreign companies operating in India sent far less money back home, our net FDI comfortably remained in the positive zone.
Okay, let's move on to Section 3, the macro impact on the rupee and our forex reserves. Aspirants, this right here is the exact macroeconomic domino effect you want to map out in your answers. It starts with the West Asia crisis, triggering immediate, widespread global uncertainty.
Exactly, which then leads directly to that massive exodus of foreign portfolio investors we just talked about. And the RBI noted this trend didn't just stop, it continued straight into April and May. That sudden, aggressive outflow of dollars simultaneously ate away at the RBI's foreign exchange reserves and, inevitably, put huge depreciation pressure on the Indian rupee.
Now for Section 4. Let's zoom out and look at the annual trend for FY 2025-26. We need that broader view. When you're writing a balanced economic analysis, you have to avoid recency bias. So, here is the highly resilient figure you absolutely should commit to memory, $7.6 billion. That is the net FDI figure for the entire financial year of 2025-26. Think about that for a second. Net FDI stood at $7.6 billion. That is a staggering 700% higher than the previous baseline financial year of 2024-25. Both gross and net FDI inflows were significantly higher.
And you know what makes this so remarkable? This 700% jump happened even though 6 out of the 12 months actually saw more direct investment flowing out of the country than coming in. It really demonstrates the immense underlying structural resilience of the Indian economy.
Finally, Section 5, bringing this all together for your GS3 and interview prep. We want to leave you with this highly probable personality test question to ponder. How exactly should the RBI balance its foreign exchange reserves amidst volatile FPI outflows triggered by geopolitical crises like West Asia? When you're formulating your answer, make sure you utilize today's data. Contrast the resilience of structural FDI against the sheer volatility of FPI, and be sure to explain stabilizing factors like lowered repatriation. Keep studying hard, use these insights to really enrich your answers, and we'll see you in the next explainer.